What's going on, everybody? Is your portfolio prepared for this? What the heck is this? Well, we're going to get into it. I'm going to explain it to the best of my ability in this video. And I want to try and help you analyze your portfolio and assess whether or not you are prepared for a certain event. Now, really quickly, for the long-time subscribers, I know I've been away for a little bit. I've been moving to Boston, and I also had a Delta variant scare, which was a little, scary. And then I also have TMJ, I think, self-diagnosed, but it's like a jaw thing caused by stress. So I can't really like bite all the way down. Kind of took that as a sign, like maybe I should, pump the brakes a little bit and just focus on remedying that and then come back to YouTube, slowly ease back into things. But I'm fired up for this video because it's something that I actually discussed with Daniel from Unrivaled Investing. So if you haven't checked out his channel before, definitely check him out. I just had him as a guest with Investor Community, which is previously my Patreon. We're trying to have more and more guests and creators and industry professionals on as like a live podcast. And Daniel had a really interesting way of going about his investing, which was what is driving market performance, right? So let's just jump right into it, and I'll explain what I mean by is your portfolio ready? And is my portfolio ready? I don't even know. Well, I do know because I made this video. But anyways, let's get into it. So let me explain this really quickly. So the stock market, right? What are the returns driven by? So the stock market averages, as we see here, about 10% annually over the past 5 years. Why did it go up by 10%? And so this chart nicely breaks things down into income, which is, here, let me zoom out a little. Income, which would be like dividends or maybe distributions, like share buybacks and stuff. Earnings, which is the light blue bar. So how fast have companies grown their earnings, right? Because as your earnings increase, that will affect your price to earnings ratio and things like that, or EV to EBITDA, right? So if a company is pinned at a price to earnings of 20 and the earnings increase, that's going to lead to a higher stock price just based on math. So that contributes to the growth of the performance of the stock market. And then valuations, right? So valuations expand, sometimes they contract, and sometimes in really bullish markets, or like the market we've seen for the past year, valuations have been expanding in a lot of different areas of the market, especially like growth and speculative plays. And by that, I mean, a typical PE ratio or price to sales ratio is higher today than it might be historically. So that's valuation expansion. And that contributes to stock market returns because at the end of the day, if your price to sales or PE is expanding, that means your price of the stock is going to increase. The market cap is going to increase, right? So what do I mean by, is your portfolio prepared? I think a lot of people who watch this channel are primarily growth investors. They invest in growth stocks. I primarily invest in growth stocks. So growth stocks, like I said before, have seen a lot of price increase due to valuation change, right? I'll put myself on the spot here. Celsius Holdings, probably the largest holding in my portfolio right now, is trading at a price to sales of like over 20, right? Even forward looking, it's really high. That, for context, is very high. Even for, if you saw a price to sales of 20, you'd think I was talking about like a tech company, a SaaS company, a cloud company, but I'm talking about an energy drink company, right? Yes, it's growing incredibly fast, but that valuation expansion has contributed a lot to the growth of the stock price. And if we were to say get rid of valuation change, if we were to eliminate this green bar from all these graphs, actually these two returns would drop, right? The red diamond represents the cumulative return of the market over the past 5 years. So the US, this would drop because valuation change contributed to the increase in stock market returns. This would drop, right? But for Europe, UK, and Japan, I think it might actually go up because valuation change contributed to a negative return for the stock market. So that probably means things actually got cheaper. And a quick little aside here that I thought was pretty interesting is the Tokyo market has peaked. It peaked 30 years ago and has not yet returned to that peak from 30 years ago. So the Japanese stock market has not been performing as well as the US market or other markets, right? Where the S&P 500, we say, oh, it always goes up. Stocks always go up. Well, so far, in the past 30 years, not in Japan. However, we are actually seeing, in 2020, also I believe in 2021, Warren Buffett is buying some Japanese stocks. And that kind of makes sense, right? Because I think there's some other reasons aside from valuation why he's buying them now. But if you look here, valuation change actually reduced the return of the Japanese market, which means that valuations probably contracted. So going back to the US stock market, right? If your portfolio is made up of a lot of growth companies that are trading at very high multiples when comparing to their historical multiple, a lot of the performance of that stock is likely tied to valuation change, valuation expansion. A stock that would usually trade at a price to sales of 5 is now trading at a price to sales of 10, for example, right? And that makes obviously the stock price go much higher. So what happens in the long run? Studies have found that in the long run, the valuation change kind of ends up being one of the lowest contributors to stock market returns. In other words, eventually, sometimes this gets wiped out. And when does it get wiped out? For example, 2008, when the market crashed, valuations came roaring downwards as all the stocks, the whole market just came crashing down. And that's when you saw a lot of the valuation change from the previous years just get deflated. In other words, erased. But it's hard to erase earnings growth because this is an actual business creating earnings. Valuation change is more, the way I see it, it's more market sentiment, right? Income, dividends, it's hard to erase that. Another example is the dot-com bubble, when all these stocks that didn't even have revenue were trading at sky-high multiples, right? Or they had barely any revenues, trading at sky-high multiples because they had something to do with the internet. Their valuations, a lot of their price increase towards the end of the dot-com bubble, all of that ride up, a lot of it was because of valuation expansion, valuation change. But then the crash erased all of that expansion for a lot of these stocks. So I'm not saying that I'm predicting a stock market crash. I don't think anyone can really predict that stuff consistently and accurately. And I hate making videos like stock market crash coming soon. My goal is not to scare other retail investors because that's, kind of messed up. But I would encourage everyone to look at their portfolio and ask yourself, go through them, run a price to earnings ratio, price to sales ratio, enterprise value to EBITDA ratio, right? Run a few ratios. You can go on macro trends or here, we'll stick with Celsius. So you can go to Y charts, right? Boom. And you can see that, Celsius historically trades around 4 or 5. And now, since 2020, it's trading at a price to sales of 35, right? That is crazy high compared to historicals. So yes, Celsius is one of my largest positions. But if I'm seeing this, I'm thinking, okay, if valuations contract again, if there's some event that makes the market contract, valuations go back to normal all the way over here. And Celsius, if I run, you can actually figure out what price Celsius will be at if you slap a price to sales of 8 on it, right? So if you just have the revenue that Celsius generates, revenue, sales, interchangeable here. But am I going to be okay if Celsius returns to these levels due to some crash in the market? I should almost plan for Celsius to return to these levels. So maybe it shouldn't be my largest portfolio. I'm always trying to readjust and prepare myself and position myself. However, it doesn't mean I'm making a trade every single day. These are things you watch, things you think through, things sometimes you sleep on maybe. But just do this exercise, right? You can do the PS ratio if it's a company that's not yet profitable. You can also just do the PE ratio. Celsius is not a great example because they just recently became profitable. We can do Apple here. Trading also at a pretty high PE ratio historically. So are you betting on these valuations to stay elevated, and are you prepared for them to go back to something like 20 versus 32 right now? So that's what I want to point out. If the valuation change gets wiped out by some event, Are your stocks, did you buy them at good value or did you buy them as they're on their way up due to valuation change? So I actually made a previous video about this on my channel. I'll link it up above, but it kind of demonstrates and illustrates the relationship I'm talking about here between stock price, earnings growth, different ratios and stuff like that. I think it's a really great visualization where like the stock price might go like this and the valuation might go like this, but earnings kind of go like this. So usually, in my opinion, over the long term, things will always come back to what makes sense. It's just a matter of when. And the thing is, if you can't predict it, then what you have to do instead is prepare for it. Make sure you are in a position of power. Some people, just having more cash is good enough for them if we see a crash. For some people, they are not buying anything this past year because they just don't see anything at good value, and that's their way of protecting themselves. So you also have to find your style. But I hope this was an insightful video, something to definitely think about, I think. And again, credit to Daniel from Unrivaled Investing for bringing up this topic in our talk with investor community. If you want to join investor community, there's a link down below in the description and probably also the pinned comment. But yeah, we're doing a lot over there. So thank you guys so much. Definitely a new style, definitely quicker. But I think this is an interesting video and I'm trying to ease back into things and just listen to my body here. But I'm happy to be making a video again. So I'll see you guys in the next one. Peace.